Last time we were doing advanced financial reporting, that was group accounts. Now today we are going to do a question from the past papers, CASNEP, and that is April 2022, question 2. I gave you that one as an assignment, so I'm going to be very brief because we have answers here. We are going to be very fast. You can mark for yourself. The question is April 2022. My name is Mr. William. Now, cash flow statements, as we said, usually are prepared so as to explain the differences arising as a result of the opening cash and the closing cash, because the net profit as reported in the income statement does not involve some actual cash movements. And okay, basically we say that in the income statement, when you are calculating the profit, you use the accrual basis concept. So for the purpose of that, I think you have all the information concerning our last time discussion. We just come back to the answer for this question, which is here. Now, you start with the operating activities, as you see here, the operating activities. But remember to start with the heading here, H Limited Group Consolidated Cash Flow Statement for the year ended that 1st October 2021. We are using indirect method. There are three headings always: the operating activities, then investing activities, and then the financing activities. The operating activities are those activities which result to the calculation of the profit reported. And the investing activities deal with the acquisition and the disposal of the non-current assets. And then the financing activities deal with the activities dealing with equity and long-term liabilities. Now we start with here, the profit before tax. That has been given. I believe you have this question. The profit before tax, as per the question, is given as 1625. So this figure is given. 1625 has been given. So because we are using indirect method, we adjust this profit here. Because when we were calculating this profit, we deducted many expenses which involved both actual cash movement and non-cash movement. So the first thing that we adjust here is that, so you usually look at the items above the profit before tax, and if that item was deducted but did not involve actual cash movement, you are supposed to add it back, isn't it? The opposite should be true. Now, the first thing that you deduct there is that I find that we have this item here, finance cost. They deducted 100. So this 100 as finance cost, it is not an operating activity. So it was deducted, so we added back. That's the reason why we have added back the 100. Then we have another figure here, investment income. Investment income was entered here, but it is not an operating activity. This is an investing activity. So we have deducted that figure because it was entered back there. Then the other item we have is a share of associate profit, 90. I find it there, 90 shillings, share of profit of associate. It is in the income statement. In that question, it was entered, so that is why we have deducted that figure here. We have now this one, gain on sale of subsidiary. I believe that is supposed to be in our calculation, so we need to establish this figure through our calculation. Now we have called that one our working gain on sale of subsidiary. So we have to establish when we sold the subsidiary, did we make a profit or loss? So most of you have the workings. I remember we said The fair value of the consideration was 310, and that has been given in additional information number, was it number 4? No, number 1. You are told during the year ended that 1st October 2021, H Limited disposed of its entire 80% equity holding in S Limited for shillings 310 million. So this 310 million is our fair value of consideration. So here, how did we calculate this figure here? We took 310, which is in additional information number 1, and then we earn fair value of investment, and that one was 0. We cannot earn any figure there because it was entire disposal. And then we minus parent company unimpaired goodwill. Unimpaired goodwill we calculated as 30. You less that, I'll show you how you calculated that. So less 30, and then we minus the net assets at date of disposal. The net assets at the date of disposal, we are given 300, additional information number 1. You are given the carrying amounts of the identifiable net assets of S Limited at the disposal date comprised of, you are given those figures there, then you have 300. So you'll be taking 300 times the 80% of that figure, and you get 240. So how did we get this figure here? Some of you are asking me how we got 40. Now we took a fair value of 310, that is in additional information number 1, you find 310 there. Then minus goodwill, 30. I'll show you how we calculated this, that here, where it is coming from. We minus 30, and then minus net assets at date of disposal. We took 80%, and then we multiplied by 300 million, we got to 40. So how did we get the 40? This is how we got the 40. We say the 310 minus 30, then minus 240. 240 means 300 times 80%. That is how we got this one. So some of you are asking me how we got the 30. That is a goodwill which is arising as a result of the acquisition of the subsidiary. We have been told that the subsidiary was acquired some times back, and they spent how much was that? 230 to be exact. 230. You find that the additional information number 1 down there, you are told, no, number 1, yeah, the investment in S Limited had been acquired several years ago at a consideration of shillings 230, when the fair values of the identifiable net assets stood at shillings 250. So how did you get this? This is goodwill, and that will be very important. Goodwill, we took the purchase consideration 230 minus fair value of net assets. The fair value of net assets will be 250 times 80%. 250 times 80%. 250 is the fair value of the identifiable net assets. Remember, they are using proportionate share of net assets, and that means partial consolidation method when you are calculating the goodwill. So that is how we calculated the 30, which you are using here. So basically, this 30 is a goodwill which arose as a result of acquisition of S. So basically, for goodwill, we have taken 230 shillings minus 250 times 80%. So to say 230 minus 200, which 230 minus 200, which is 30. So that is the goodwill. Now from there, we have this figure here, which is impairment loss on goodwill. The impairment loss on goodwill. Now this is calculation. I'll show you this calculation. Where there are calculations, I'll show you that. There are other calculations which are straightforward, like this one. I'll show you that. Gain on disposal, I'll show you that. Depreciation this one has been given, depreciation has been given at 260, additional information number 4. So the depreciation for the year for PPE was 260. So when arriving at this profit, that figure had been deducted. So we add it back. So that is where we entered this one there. So that one does not require any explanation, does not require workings. Now basically here, when it comes to operating activities, you are supposed to get the profit before tax and back any expense which was deducted but does not involve actual cash movement. You add it back. Any income which was earned but does not involve actual cash received should be deducted. So by so doing, finally here, you will get cash flow before changes in working capital. So after you get this figure, 2017, remember the ones which have a star, they have workings. If I have time, I'll do the workings for you. Now, changes in working capital basically means the current assets and the current liabilities. Mostly, they will give you the inventories, the debtors, and the payables or the creditors. So here, we usually compare the opening balance with the closing balance. Here, consider when you are dealing with this, the inventories, the receivables, and the payables, consider the disposal of S Limited. When we dispose this particular company, and that is additional information number 1, when we disposed S Limited, the S Limited was having some inventories, some payables, and some receivables. So these figures must be deducted. You have to deduct these figures which were in the books of the subsidiary, which was deducted. So you'll be comparing the opening balance and then these figures which were being disposed. For example, if we look at inventory in the statement of financial position, the opening balances have been provided as well as the closing balances. But remember to adjust these figures here, the amounts which are in the books of the subsidiary, which was disposed. I believe this one was straightforward. We discussed this one last time. Most of you find challenges in dealing with the items which are in the books of the subsidiary, which has been disposed. So always when you are doing the group accounts, try to look at whether there was acquisition of a group member or there was a disposal of a group member, and then you do the adjustments accordingly. So away from that, once you have done this figure, tax paid, I will show you the workings for the tax paid, how we arrived at 1716. Interest paid, basically this is the interest you find here, the finance cost. We removed it from here. It had been deducted, so you earn it back because it had been misplaced. If an item has been misplaced here, then you have to take it to its right position. So we removed this finance cost here. This can also be interest, it's the same as interest. So we brought it here and we deducted that figure from there. So this one is straightforward. But once you have done all these adjustments, we get 105. That is starting from profit before tax, follow all these steps, and then finally you arrive at net cash flow from operating activities, 105. Now away from there, we go to investing activities. Now investing activities entails the acquisition and disposal of non-current assets. Now the first item here is disposal of subsidiary. We are told in additional information number 1, there was a disposal of subsidiary which had been acquired some times back, and when they disposed that subsidiary, they received 310 shillings. This figure, here we have said 310 minus 30. Why are we saying minus 30? Because when we disposed S Limited, if you look at additional information number 1, there is cash and cash equivalents of that shillings. So we have to less this one. So what we received was 280. So we consider only 280 and not 230. Now from there, we have other items like disposal of plant, and 560, you find it in additional information number 4. They disposed a plant and received cash proceeds of 560. This is a plus. 560 is a plus, it's money in. Disposal of finance asset 360. That you find in additional information number 5 down there. This is what we received. Purchase of finance asset, that has been provided. I think that has been provided in additional information number 5, less and purchases of financial assets. 515, this has been provided. We are lessing it. Is man out. Now, dividends received, I'll show you calculation for that. Dividends from associates, I'll show you the calculation for that was 145. Then acquisition of PPE, 935. This is in the workings, 935. Then finally, when you adjust these figures, investing in activities, finally the answer is 75. So this is the total income. The net cash inflow from investing activities is 75. For operating is 105. Now, the last item is financing activities. This is to do with equity as well as long-term liabilities. Issue of shares. If you look at the statement of financial position, you started with 6,000 and you closed with 8,000. That is in the statement of financial position. So there is increase by 2,000. So that is provided straight away. Dividends paid by parent 290 is a minus. This is in our workings. Dividends paid to NCI. This is also in our workings. These are in our workings. I'll show you the workings. Repayment of long-term loan. This is straightforward. You look at the long-term loan, compare the opening balance with the closing balance. You have this figure. Then net cash inflow from financing activities. If you do all that adjustment, we get 1230. So we are considering cash from operating activities. We got this figure here, 135. We plus 75 is investing activities, cash flow from investing activities, and then the final figure here, 1230, cash inflow from financing activities. So our final answer should be 20, not 20, but 135 plus 75. Remember, 135 is net cash inflow from operating activities plus net cash inflow from investing activities, 75, plus cash inflow from financing activities, 230. Then we get 1440. Now, 1440, we earned cash and cash equivalents brought down, which is 2745. That has been given in the statement of financial position. And then you get the cash and cash equivalents carried down, 4185. So you find that after adding these three items, then you get 1440. You earned 2745, which is the cash and cash equivalents brought down. You get this one, and these figures now, they are in agreement. Now, that is how we are supposed to present our cash flow statements. Now, for the purpose of workings, because most of you got this question correct, but this is how you should have presented that. I think I'll be doing the workings separately elsewhere, but this is how I expected you to attempt that question. First, understand you must show the heading well. Operating activities, they are telling us to use indirect method, take that profit, adjust it accordingly this way, and then adjust the changes in working capital accordingly. Investing activities, we have said you do this way, and then financing activities this way. When you earned those three items, you got 1440, and that the 1440 is net changes in cash and cash equivalents, and then you plus cash and cash equivalents brought down, you get cash and cash equivalents carried down. And that is how you are supposed to go about that. Now, for the purpose of conclusion, because we'll be doing workings after 1 hour, I'll show you workings, because some of you were having challenges with the impairment of goodwill, how we got the 105. I will do the workings for you, but meanwhile, I expected you to attempt this question this way. So it is Advanced Financial Reporting Custom April 2022. It was question number 2. So we have said for the cash flow statements, we are interested with what brought about the difference between the cash that we opened with and that which we closed with. We just want to understand that. So in our question, we wanted to explain what brought about this difference here. And the difference was 1440. So it is like being told, you opened the bank with 2745, we closed the bank with 4185. Explain to us what that difference, where that difference came from. So we have explained that the 1440, 1230 was from financing activities, some money coming in, others going out, and then the operating activities we have 135, some of it coming in, others going out, and then 75 was coming from investing activities, some getting in, others going out, and we are able to present our cash flow statements accordingly. So I think for now we stop at that, and then after 1 hour I want to show you all the workings now, especially how did we calculate gain on sale of substantially, how did we calculate impairment, gain on disposal of plant, how did we arrive at all these figures. That is what we are going to do after maybe 1 hour. But make sure you are very conversant with the T accounts mostly, the assets, where you have assets, where you have liabilities, where you have equity. Bring down the balances accordingly, and mostly the difference now reflects either a plus or a minus by the end of the day. So that is the end of that for today. So let's meet after that minutes for the workings now. Thank you.